Welcome to Killik & Co.'s Wealth Planning video. Today, Sarah Lord, Managing Director of Killik Charter Financial Planners, will be discussing the key financial planning points for those who are approaching retirement. Sarah, what are the key things that should be considered as you approach retirement?
Well, Sophie, the likelihood is that your children will be less dependent on you financially, but there will still be many areas that need to be considered. For example, how will you spend your time? Will your mortgage be repaid, or do you plan to move house? And ultimately, what level of income will you need, and where will this income come from? Working with a Killik Wealth Planner to identify your financial goals, prioritise them and then put in place a strategy bespoke to your needs will assist you with ensuring that you are giving your financial future the best possible start.
I guess repayment of the mortgage is a key aspect.
Absolutely. Most individuals during their working life have each month been making payments to their mortgage, often without much thought. However, as retirement approaches, consideration needs to be given to how the mortgage will be paid off and if it will be paid off before the intended retirement date. If you have a repayment mortgage, you have the assurance that the debt will be repaid at the end of the term. However, many individuals have an interest-only mortgage, which means that at the end of the term you need to ensure you have the capital to repay the mortgage. The years leading up to retirement is a good time to review your finances to ensure that you're going to be in a position to repay any mortgage liabilities before you retire. Particularly if you have an interest-only mortgage, it is important to ensure that you have sufficient savings and investments, or if you don't, is it your plan to downsize? If so, how much will this generate, and will it be sufficient to repay the mortgage? Over the years, many people have looked to the tax-free cash entitlement under their pension as a source of capital to repay the mortgage. However, this strategy really is not appropriate for everyone, as it can have a detrimental impact on the capital and income you receive in retirement, and for some means that whilst the mortgage is paid off, they don't have sufficient funds to live off in retirement.
In the current economic environment, how does an individual ensure that they have sufficient income for retirement?
Individuals looking to retire at the present time have a number of important factors which need to be considered, as it can have a significant impact on the level of income in retirement. For example, we remain in an environment with historically low interest rates, which means that the returns being received on cash are at all-time lows. Annuity rates are at very low levels, therefore the amount of income generated from a pension pot is lower than it may have been in the past. Or putting it another way, individuals need to have more in their pension to generate the same level of income. For many individuals, retirement planning will revolve around pensions. However, it's important to remember that there are a variety of methods of providing income and capital in retirement, and planning should not be constrained solely to pension saving. The main focus should always be on determining the objectives for retirement, such as when to retire and how much income will be required, and then building an achievable, tax-efficient and appropriate plan to meet those goals. A self-invested personal pension, more commonly referred to as a SIP, can be an excellent arrangement for many for their retirement savings. A key advantage of a SIP is the wide range of investment choice and flexibility that they can provide. By holding your pension assets in a SIP, a Killik & Co broker can tailor an investment strategy for your pensions that is bespoke to your requirements, attitude to investment risk and time horizons. By working with a Killik Wealth Planner and broker, you can determine the most tax-efficient way to plan your retirement income, whether this will be provided solely from your pensions or it be tax-efficient to use other assets you hold as well. There are a myriad of options available as to how you can take your pension benefits, ranging from income drawdown, annuity purchase, or any combination of the two. A Killik Wealth Planner can guide you through all these options to determine the most suitable approach for your personal circumstances.
Is it also important to consider how your estate is structured when you're looking at your retirement objectives?
Very much so. I believe that it's important to look at your finances holistically, and therefore you should not just consider your retirement objectives in isolation. Any retirement planning strategy should also form part of an estate planning strategy. At its very simplest, estate planning is about deciding how you would like your estate to be passed on and when you would like the process to begin. Once this has been determined, however, there will likely be a variety of ways of achieving your objectives, some of which may be more suitable than others. Though some individuals may have less need for an estate planning strategy, for example where the assets are to be gifted to charity, it's still worth considering the potential inheritance tax implications of lifetime transfers and gifting, and how these may impact the value of an estate. Inheritance tax can cost your family thousands, but with careful financial planning in conjunction with a Killik wealth planner, you can ensure that you minimise the impact of an inheritance tax on your estate by making full use of yours and your family members' tax allowances.
To find out more about how Killik & Co can assist you with achieving your financial goals, please speak to your broker. Or if you're new to Killik & Co, contact us on the details to follow.